Hello, testing 1 2. Um, my name is Troy White. I'm with Hoodoo Financial. Excuse me. And please like this video. Please share this video. Please subscribe to this YouTube channel. All right, what I want to talk about today is the difference between two ways of investing, two methodologies. Actually, they're not methods, they are more philosophies of investing that lead to various methods of investing. And it's very important that you understand the difference. It's going to be a little bit technical, but you'll be able to follow what I'm talking about. So these methodologies are legacy investing and a life cycle phase investing. So, although legacy investing may sound a little simpler, in fact, life cycle phase investing is the way the world currently invests. And when I say the world, I really mean average people in your 401k. You are being advised to invest in this manner. And this, what I mean is according to the phases of your life. So those phases are considered a life cycle. And that cycle starts with, the early part of your life where you are supposed to accumulate assets, accumulate assets by starting to invest a little bit at a time earlier in your life. And then as you reach the midlife, the midlife crisis, you should be protecting what you have done. But remember, that assumes you had started earlier investing. Okay. So in the midlife, you protect your assets so that later in life, you will distribute your assets to yourself. So let's break that down even simpler so you can understand what I'm talking about. And then you'll realize this is how you currently invest. So in your earlier part of your life, you are more aggressive with your investing. And specifically, this pertains to stock market investing. So you are more aggressive. In the middle part of your life, you get to be a moderate investor. And then in the later part of your life, you are a conservative investor. So what's that mean when a rubber hits the road? That means that earlier on, you can take more chances because you have a longer time horizon to recover when you screw up, if you screw up. During the midlife, you want to hoard what you had because you cannot recover from market declines, in theory. And then in your later years, you shouldn't be investing in the stock market much because you don't want the ups and downs to affect what you have. Because you are distributing to yourself your assets. Now, let's get even more simpler than that. You've probably heard that in the early part of your life, you have more stocks than bonds. And in the mid part of your life, you have a 50-50 split. And then in the later part of your life, you have no stocks or very little stocks and mostly bonds and or annuities, which are guarantees on your assets. So annuities are an insurance product that guarantees your money. It insures your money. So you are constantly when you select your 401k at your job, you probably do check a box that pertains to your age. And what that does this for you. It invests this way for you. And so think about it. Why does it concern about your age? Because if you are below 30 or somewhere around 30, say between up to the age of about 40, 35 to 40, then it will be somewhat aggressive with the stock selections. If you are approaching 50 or in your 50s, it will then become moderate in terms of the investments, the stock selections. And then when you are approaching retirement, so 55 to 60, 65 plus, it's going to be practically no stocks and mostly bonds because it assumes you cannot withstand the ups and downs of the stock market. So this type of investing requires you to die before your money run out. So it's assuming a life expectancy that goes with the actuarial accounting. Actuarial accounting means basically the numbers and statistics show that a person like you dies at this age. Therefore, whatever the age, it depends on what type of person you are. If you're a male or a female, if you're a Caucasian woman or a Caucasian man, if you're an African American woman or African American man, you can look up the numbers, they all are supposed to die at a certain time based on the numbers. Based on the numbers in our society, we know, oh, you a black man, you finna die at X amount. So it's going to invest accordingly. But this means that this is all based on a risk reward trade-off. So the risk tolerance of the individual and the risk reward trade-off that you are able to accept. And it's assuming you have a lack of understanding on the cycle of the economy. And those things go together like this, because I'm going to break down basic. I don't want to insult you, but basically, if you don't know what the hell you're doing, then they know that what you're going to do is get scared when the stock market go down and you're going to sell all your stock. So what that means is you're going to buy high and sell low, because that's what most people do. Stupid. But and let me reiterate, the only way you make money in an economy, whether you're selling pencils, cars, houses, anything, stocks, anything, you have to buy low and sell high. That's the only way. Even when you was a kid, you sold candy at school, you had to buy it at one price, give it a markup, and sell it at that higher price. That's the only way you make money. But most people in America that try to invest on their own buy some stock, and then when the news gets bad and the stock market goes down, they get scared and they sell it. So they buy it up here, stock market go down, they sell it down here. But in fact, what you should do is understand that happens all the time. Stock market go like this. It's a cycle. So it go up and down. It really go like this on a climb up. But all of them little dips are stock market declines. So when you hear that the stock market went down, you should understand about the stocks that you're investing in. You shouldn't be investing in it if you don't understand what you're doing. But if you pick that stock because you felt strongly about that stock, but then when the market crashes, buy some more instead of selling. So that goes in hand with your risk tolerance, your understanding, your knowledge of investing. And if you did that, then we wouldn't have to do life cycle phase investing, what I just been talking about, because that means you are more likely to run out of money before you run out of life. And so that's dooming yourself to poverty at some point. And that point is going to be when you're an old elderly person, no longer able to work and bring in money. So you should be legacy investing. That's investing for the duration of your life and the lives that come behind you, meaning your kids and your kids' kids. Because this type of investing understands that the market goes in a cycle and understands that you should be investing so that you never run out of money. And that requires a completely different type of mindset in your investing and a completely different type of asset class when you're investing and a completely different type of cycle of your investment dollars. That cycle, just briefly, is you save your money, you invest your money in the stock market, you take and as your assets grow, you take those assets and you use a down payment on investment income property, real estate. You take the income from those real estate assets and you refunnel that into the stock market. And as those assets grow, you use another down payment on more property. And with those properties generate income, you buy more stock market assets. As those assets grow, you use more of those assets for a down payment on more real income generating real estate. Over time, you will have income that steadily produces more income, but produces more assets. That income will be what you live on in your retirement, instead of life cycle phase investing requires you to build it up and then just slowly chew away at it until you die. So it's hoping that you die right when your money runs out. That never happens though. So legacy investing is harder because it requires you to engage with investment professionals, and it requires you to understand more and learn more about what you're doing. But it pays off more because it builds a legacy for you and your family. It doesn't burden your family with you as a destitute individual who needs their support in your elder years. And how many of you started investing early enough to build up your assets such that they are enough for you to retire on and just live on your 401k or your investment dollars? Most of American human beings do not have that. So if you're not in that situation, all right, what if you started late on investing to do the life cycle phase investing, meaning once I get to my later years, I'm going to reduce my stock market participation. If you didn't do that already, then you have no choice but to engage in legacy investing. That means you need to make your dollars work harder and smarter. So I'm going to stop there because I can keep talking about it forever. But check out some of my other videos and you can get some more insight if you want to hear more about it. Reach out to me. We can, I'll consult with you. You're going to have to open an account for me to be a client, and then I can help you with that. But please like this video, share this video, subscribe to my YouTube channel, and you will hear more information about this and how to invest for your legacy and not just life cycle phase investing, especially if it's already too late for you. You already passed those phases. So now what? You still need to retire. You still need your money to generate an income for you in your retirement years. Thanks for listening. Holla soon.